Today, I'll be answering the question, can capital gains push me into a higher tax bracket? And in my years of helping people plan for taxes in retirement, this question around capital gains taxation and how it impacts your other income seems to come up quite often. And that's exactly why I'm making this video today, to show you everything that you need to know about the interaction between capital gains taxes and your normal income. And be sure to stay to the end because I'll be sharing 3 major mistakes that retirees often make when realizing capital gains and how you can avoid them. But first, if you're new here, my name is Jacob Duke. I'm a certified financial planner and the owner of a retirement planning firm where we help people just like you plan smarter and retire better. All right, before we jump into capital gains taxation, we first have to understand how the normal income tax brackets work. So right here on screen, you can see the federal income tax brackets. And for married filing jointly here in 2025, we have the 10% bracket, which ranges from 0 to $23,850. And for single folks, it is exactly half of that. So that's the first bracket, the 10% bracket there. Now this jumps go up to the 12% bracket, and you can see the ranges here. And so the thing to know about the tax brackets here is that these are not all or nothing. This is what's called a progressive tax system. So the dollars that fall in this 10% bracket, they're always going to be at 10%. So the first $23,850 of anyone's taxable income, that will be at 10% no matter what, regardless of how much other income you have. Now the same thing applies here for the 12% bracket. If you go from $23,000 to $96,900, all of the dollars that fit within that bracket will be taxed at 12%. So that's an important thing to know, is that if you eclipse a certain tax bracket, not all of your dollars are taxed at that rate, which is why the effective tax rate that you will have on your tax return is often well less than what's called your marginal rate, which is the top bracket that you have gone into. So that's important to know, because as we look at the long-term capital gains brackets or the capital gains brackets in general, they are going to have a progressive functionality to them, just like the normal income tax brackets. We'll outline this here in just a moment, but just know that first. Now, if we look at the actual long-term capital gains brackets here, we can see there are 3 different rates. We've got 0, 15, and 20%. Okay, so those are the 3 rates that a long-term capital gain could be taxed at, depending on how much other income you do or don't have. Now, what's important to know here is that at all times, the short-term capital gain rate is going to be the normal income tax rate. You do not have a benefit of having a short-term capital gain being taxed at a lower rate than your normal income. So the key here is, if you've got an asset that you've held for 350 days, you might want to think about holding that for another 15 to 16 days so that you can qualify for that long-term capital gain treatment of holding it for at least 1 year before you sell it, because it could mean the difference of at least 10 or 8% difference in tax there. So that's important to pay attention to. Now let's look at how this actually functions. So you can see here, to qualify for the 0% rate, married filing jointly, we'll just focus on the married filing jointly folks. The exact same thing works the same way for single filers, but for married filing jointly here in 2025, you can have $96,700 of taxable income, okay? Not gross, not modified adjusted gross or AGI. It's your taxable income. You can see that right here. You can have $96,700 married filing jointly in 2025 and not eclipse that 0% bracket and overflow into the 12% bracket. I'll show you exactly how this works in an example in just a moment, but that's the key, is that you can have gains at the 0% rate long-term and also the 15% rate. They're not cliffs. This is progressive. So for example, if half of your capital gain at a long-term rate would be at the 0% rate and the other half would overflow into that 15% bracket, then half would be at 0% and half would be at 15%. And what's really interesting about this is that your long-term capital gain rate is always going to be lower than whatever your normal income tax rate would be for that same amount of money. So for example, you can see just really quickly here, the $96,700, that's the top of the 0% long-term capital gain bracket. Well, if we look back to the 12% bracket, that goes up to $96,900. So they almost match identically. So that's just saying that you can have a long-term capital gain up to that amount of money, $96,700 at 0%, while normal income or a short-term gain would actually be taxed at 10 or 12%, because those brackets pretty much align equally. So up to 10 or 12% for normal income, and then 0% is what it could be if it was a long-term capital gain. And the 15% bracket makes up a very large sum of money, which goes up to the $600,000. So about halfway through the 35% tax bracket married filing jointly. So you can see that from right here up until about here, that's where the 15% long-term capital gain bracket is. And 15%, based on my math, is a lot lower than 35. It's a lot lower than 32 and a lot lower than 24 and 22%. So you can see that long-term capital gain rates are very favorable, and that is the benefit of having that brokerage account beyond just having liquidity that's after tax, but having that ability to realize gains at 0 or 15% in retirement could be huge. So that's normal income taxes at the federal level, and that is capital gains at the federal level. Let's look at how this actually works together. So the question that we're trying to address here is, do my capital gains actually push me into a higher tax bracket? And the answer is no, they do not. You cannot push your other income into a higher tax bracket with capital gains, and here is why. Let's say that we have, I'll change colors. Let's say that we have $50,000 of normal income, whether that's earned income or a pension or Social Security or IRA distributions. Let's call it $50,000. Okay, and then we have a capital gain of, we'll call it $30,000 that goes on top of that. That's an AGI, or a total income of $80,000. But here's the key. This $30,000 of capital gains, whether it's short-term or long-term, that gets stacked on top of the other income, not before. So the reverse of this would look something like this, where we have $30K here and we have the $50K on top, okay? This is not correct, by the way, but this is saying if we realize capital gains, it would actually push our other income that we already earned into a higher bracket, because it's getting the income is getting stacked on top of our capital gains, as opposed to the correct way that this actually works is your capital gains are stacked on top of your income. So whether or not you realize a capital gain or not, it will not change the tax status or the tax rate on your other income sources. The key here, though, is how much your capital gains will be taxed at, and that's what I'll go into next. So for example, let's look at, let's just change the example just a little bit here. Let's say that we have $80,000 of normal income, IRA, pension, Social Security, earned income, doesn't really matter. And then we have, let's say, another $80,000 of capital gains added on top that are realized at a long-term rate. Long-term, short-term doesn't matter, but in this scenario, we'll use a long-term rate. So it's $160,000 of total income, okay? What we've got to do here is we've got to say how much of this $80,000 is going to be taxed at 0% and how much of this is going to be taxed at 15%, because it is a long-term gain. It qualifies for one of those two things. This down here is unaffected, okay? So that's the key. Your normal income here is not affected because of this realized capital gain. So let's look at the tax brackets and evaluate how much tax would be paid on those $80,000 of capital gains and see what we come up with here. So $80,000, 160 is the total amount. The first thing we would do here is we would say, hey, we've got 160. We subtract out our standard deduction of $31.5 thousand. This is married filing jointly. This is the new standard deduction updated after the One Big Beautiful Bill here in 2025. So we subtract that out. We're going to have, what is that, 128.5 left over. So that is our, what we'll call our taxable income, okay? So 128.5 is our taxable income. We're now going to run, so of that though, I'm sorry, 80,000 originally was taxable, but this 31,500 standard deduction, this is actually being taken out of the normal income. It's not being taken out of the capital gain. So that's another key point here is the standard deduction applies to your normal income. It does not apply to the capital gains, which is really helpful. So out of this 80,500, really only 48.5 is actually going to be subject to taxation, because that's 31,500. Standard deduction is taking up the other portion there. And again, this doesn't account for if someone's above 65 and they have the additional deduction for the old age or being blind benefit. And this does not also account for the standard deduction increase for the next 4 years under the One Big Beautiful Bill. If you have those opportunities for yourself, they would be added on top of this 31.5, making less of your $80,000 of income being taxable. So that's important to factor in. I'm not including it here just to kind of keep everything the same for the most amount of people out there. So we've got 48,500 that will be taxed as normal income. The other 80,000 is going to make up that 128.5 here. So the 48,500, that's going to fall under the normal income tax brackets. We'll get to the 80,000 here in just a moment. So if we run this through the brackets, the first, what is that, 23,850, that would be 23,850. I'm not going to do the math just to keep it simple, but that would be at 10%. And then everything that's left over, that'd be, I don't know, it's not exactly right, but close to $25,000. that would be at 12%. Okay, so you can calculate how much normal income tax you're going to pay on your normal income here, just if you did the math there. Now, the key I want to focus on is this additional $80,000 of capital gains. What's important to know is that the $96,000 here, okay, that room, $96,700, that's what we're playing with at the 0% rate before we go into the 15% bracket. So if we've got $96,700 of room at 0% for long-term capital gains, we actually have to subtract out $48,500 since that's our taxable amount of normal income. And again, because capital gains are stacked on top, we have to subtract that amount out of the capital gains bracket at 0%. So what we've got here now left over is $48,200 of room in that 0% long-term capital gain bracket that can be used against the $80,000 of total capital gains. So $48,200 of our $80,000 capital gain is actually going to be taxed at 0%. The additional amount above that, so if we subtract that out, that would be, what is that, 31.8, is that right? Correct me if I'm wrong there in the comments, but 31.8 is left over, and that's the amount that would be at 15%. So what's important to understand here is that just because someone goes over the 0% long-term capital gain bracket with $1 or any amount of money above that, not all of the dollars are at the 15% rate. Again, this is a progressive and gradual tax system. So any dollars that are at the 0% rate are taxed at that rate as you see here. So in this scenario, you have two different components of your total taxes to be paid. You have the total tax that's generated and to be paid on your normal income, calculated under one side of the tax code. And you have the capital gains taxes that are getting added to that based on a different tax bracket or tax code for capital gains specifically. So hopefully the two big takeaways you're seeing here is that your capital gains are stacked on top of your normal income. They do not impact or push your normal income into higher tax brackets, but you do have to factor in your normal income when calculating how much of your capital gains are taxed. Because again, this $48,500, that used up a portion of the 0% long-term capital gain bracket, which is up to $96,700. So that's the big things to know here as you're evaluating long-term capital gains. But there are a few things that people often overlook that I want to tell you about right now. So the first thing is that because we can realize a capital gain at 0%, many people start realizing those gains in retirement up to the $96,700 bracket. But the problem is they're not considering a couple different things. The first thing being, what is happening to your Social Security taxation by increasing your AGI, which is in turn going to make more of your Social Security benefits taxable. And again, I've done taxation on Social Security in other videos. I'll have those linked down in the description below for you to go watch and understand how that works. But by creating more capital gains, even if you're going to pay no tax on the gain itself, it could force more of your Social Security to become taxable. That's the first thing. The second thing is, if you're realizing capital gains at the 15% bracket because you're like, wow, I'd be paying 30% or more on this if it was normal income, might as well do that. The problem is if you're 65 or older, you could be creating a IRMA issue for yourself, which stands for Income-Related Monthly Adjustment Amount. And this has to do with your Medicare premium. So if you're realizing capital gains at 15%, that might be a really cheap rate for you historically and in the future to do so, but you could be causing yourself to pay higher premiums on your Medicare 2 years in the future. So you got to pay attention to those IRMA surcharge brackets as well. And those are going to be found right here on this document. And by the way, if you want the copy of this document, I'll send this over to you completely free. All you have to do is click the link down in the description below, fill out the forms, type your name and email in, and then I'll send that over to you. It's completely free for you to use, and it's a really helpful resource. So that's the second thing is you got to watch out for IRMA surcharge brackets and make sure you don't go over the cliff, because here's the thing, those brackets are cliffs. Those are not progressive, okay? So you do not get a free pass if you eclipse that by $1. It's a cliff. Once you go over it, you will pay that next level of the brackets. And finally, if you are before 65 and you are trying to qualify for subsidies, okay, for your health insurance through the ACA program, you might be able to realize gains within your brokerage account at the 0% rate. But here's the thing. If you don't watch out, $96,000 of capital gains at 0%, you can do that absolutely and pay no tax, but you could be forcing yourself above those ACA income limits and thresholds, forcing you to pay higher premiums for your private insurance before 65. So those three things, they're not directly affected by capital gains in terms of the taxes you're going to pay on the gains or your income, but they do indirectly affect a few other things things that are specific to retirees that you've got to watch out for. And while I've explained the concept here today, applying this to your situation and working this into your retirement plan, that can be the hard part. So if you're someone that's looking for help with your plan and needs somebody to help think about these things in a comprehensive way, click the link down in the description below to schedule a call with me. Again, my name is Jacob Duke. I hope this video helps you plan smarter so you can retire better. See you next time.